As Ravneet Gill joins us now, CEO of Yes Bank, to walk us through the numbers for the quarter gone by. Good morning, Mr. Gill. Now, we must acknowledge the fact that the bank has reported some profits after a huge loss of 1,500 crore last quarter. However, the overall operating performance is still under pressure. Give us the highlight of the performance.
When we say that even though we return to profitability, which itself is a strong statement, I think if you see our revenues and our pre-provisioning operating profits, those actually were very strong. But for the fact that there was this one-time mark-to-market, a charge of 1,100 crores, I think our net profit would have been a lot higher. I think what this needs to be seen in context too is the previous quarter. To begin with. Second, the fact that during this quarter, our management transition was getting completed. Also, if you look at it from the point of view of, the challenge in the overall macros in the economy, the tightness in the credit markets, the dislocation in the NBFC space, and the fact that, we were stabilizing our asset quality and reorienting certain of our businesses. So if you look at it as a combination of all these factors, I would think that, this really does represent a very credible performance.
Your press release mentions that part of slippages are from BB and below rated book. Just for the benefit of our viewers, what is the quantum of B and BB below rated book now, and how much has slipped from those two categories?
I think the key point to recognize here is that the watch list of 10,000 crores was culled out of the sub-investment grade book of what was 23,000 crores in the last quarter. The sub-investment grade book has grown to about 29,000 crores in this quarter, and the increase that you see over the last quarter is almost completely on the back of two names, which were our exposures to large financial services players. But for the point that you made with respect to some of the slippages that came during this quarter came outside of that sub-investment grade book, that's not correct. They may have come outside of the watch list that we had put aside or we had identified, but all of the slippages came actually from the sub-investment grade book. And as far as the watch list itself is concerned, which was 10,000 crores, what we had indicated was that those were the accounts in which we could have seen some short-term slippages based on some short-term repayments that were coming up. But only 25% of that book actually slipped. And then the rest of the slippages came from the rest of the sub-investment grade book. And I think that has bottomed out. If I look at my overall corporate book, two aspects which I'd like to highlight. The first and foremost is that the overall SMA2 component of that book is only 404 crores. And the second is that often questions get asked around the real estate exposure that the bank has. The total exposure that the bank has to that sector is about 24,000 crores. About 25% of that exposure is already captured in the BB and below book and in terms of the provisioning that we made so far. And the SMA2 for the rest of the book is just a minuscule 255 crores. And this 255 crores is obviously part of the overall 404 crores that I talked of the SMA book of the overall corporate portfolio.
Okay, now there have been various reports in the media and also by analysts suggesting that there are 3 to 5 accounts which are stressed and most of the banks have exposure to them. Without getting into the names, what is Yes Bank's exposure to these 3 to 5 stressed accounts? How much has slipped and how much provisions have been made?
The exposure that you're talking about, from a client confidentiality perspective, it won't be prudent for me to talk about the total exposure to those 3 or 4 names that you talked about. But the important thing here is that most of those exposures are absolutely current. Part of those exposures are in the form of investments where we have taken the mark to market, which is reflected in this quarter's performance. And if there were other exposures which were funded, non-funded, which have slipped, on those we have taken, the regulatory exposure in full. But do bear in mind that even though these names may be currently facing headwinds, these are not, most of these exposures actually are still standard in our books. And to that extent don't require, excessive provisioning at this stage, but whatever has slipped is fully provided for.
So if I'm not mistaken, the double B and below rated book stands at about 23,000 crores. There are concerns about the entire double B and below rated book now slipping over the next few quarters. What's the probability of that, of both entirely slipping?
As I mentioned previously, I think, in terms of asset quality, this quarter we have stabilized. I don't expect, the double B and below book to expand from here. If anything, it should start contracting because some of these large concentrated exposures that we talked about, I expect resolution to happen in these names in this very quarter. So if anything, you will see a contraction in this book. I will again say that, it is important to recognize that the watch list was, culled out of this sub-investment grade book. These are not two separate pools of assets that we have. So if we are not changing the watch list at all, the watch list was created for a very specific purpose. That was to be able to give, in a very transparent, proactive fashion, some signaling to investors where potential slippages could have occurred, and we wanted to do that before raising capital rather than doing so after. And as it turns out, I think we were more conservative in terms of our assessment of that watch list because only 25% of that slipped. Having said that, there is no intention and there is no need to change the complexion or the size of that watch list of 10,000 crores. And equally, like I said, that if I look at my sub-investment grade book of about 29,000 crores, I think it's bottomed out. From here on, it has peaked, and from here on, we will only see a contraction.
Now, Ravneet, morning. The recent ET Now exclusive has stated that PE investors and domestic investors are looking to infuse close to $850 million in capital. So, A, can you confirm this news? And B, if you could help us with any update on the quantum, the timing of this fundraising, because it definitely had an impact on the stock and the street is very curious.
So I think, again, I'll answer this question in two parts. The first and foremost is that it's important to recognize that what the capital that we're looking to raise is only growth capital. I think our PPOP is enough, to be able to absorb any slippages that may occur in our sub-investment grade book. So we are not looking to raise capital from a provisioning standpoint. Our capital is very much going to be growth driven. The second part is it would be inappropriate for me to comment on the article that or rather the news flash that had appeared on ET Now. What is absolutely true is that we are in very close engagement. We are very closely engaged with both public and private side investors. They have a lot of interest in investing in Yes Bank. They see that the Yes Bank portfolio, when we look at it from an asset quality perspective, is really just a handful of names, not a very large granular portfolio, which is suffering from some cycle. And that fact that with each resolution that happens, it materially improves the upside for them. So we remain very, very engaged with these investors, and are in discussion. But beyond that, for me to say anything at this stage may not be right.
Okay, that's the view coming in. Fair enough. Not divulging too many details on that front. But moving on, what are the milestones that investors should be tracking in terms of, the capital front, your operating performance over the next 3 to 4 quarters? What are the targets that you've set in place?
We obviously set, very clearly defined quantitative goals for ourselves in terms of whether it's on the revenue side and within revenue, how it tracks between various businesses, on the cost side, and very importantly on the asset quality side. So I think those parameters are very, very clearly laid out in terms of what we think should be in line with what our growth aspirations are, what the market opportunity is. But I think we will be able to articulate them with greater clarity post the capital raise, because that will have a big impact obviously and a big influence obviously in terms of what the growth trajectory in the coming quarters looks like. So I think we will be able to provide a lot more granularity around that in the quarter as we go along.
So one more question, could you give us more clarity on the timing of the capital raising? Can it be completed in next 2 quarters?
So like I said that, the operating performance for this quarter in a reasonably, challenging times gives us a lot of confidence in terms of, our operating performance, which also gives us patience with regard to capital raise. Having said that, we've said this in the past and we'd like to stick to that, for us capital raising should be a Q2 event.
Now, margins have been under pressure, fee-based income has declined. However, we are also seeing that the share of retail deposits have increased slightly. Give us some outlook there.
So I think, an improvement in margins is a function of two things as we see. The first and foremost, as I've said, is that, we have now become a very liability-focused bank. And even in this quarter, what we saw in terms of the retail liability piece was very heartening, very encouraging. The second part of it is that if you look at, the NIMs that we have reported for this quarter, they get in somewhat masked by the fact that we had to de-recognize, revenues of almost 230 odd crores on the back of provisioning. So that did artificially depress, the margins. But as I see it, as the asset quality now begins to stabilize, as our liability strategy, especially on the retail side, starts to gain momentum, I can clearly see a margin expansion in the coming quarters.
Okay, just for the benefit of our viewers, if you could give us some color on what the kind of discussions are that the management has been having with the regulators, be it on NPA recognition, whistleblower complaints, and so on.
We have been very closely engaged with the regulator and providing them a lot of data, a lot of data points, a lot of MIS around our operating performance in terms of our capital position, in terms of our asset quality. And I can say that the regulators have been very comfortable with that. It's a very constructive engagement, which has become even stronger post the appointment of Mr. Gandhi as an additional director by Reserve Bank of India on the board of Yes Bank. With all the experience that he has, the standing that he has, his background as Deputy Governor of DBR, I think he brings in a lot of regulatory insight in terms of the governance of the board, and has obviously strengthened the overall functioning of the board of the bank. So I would say that our relationship with the regulators is very transparent and a very constructive one, and I think we will just continue to strengthen that going forward.
And finally, any management changes that are expected in the bank? Can you tell us about the recent senior hires as well that the bank has undertaken?
So, as we disclosed some time back, we've had 2 senior hires. We brought in somebody as head of compliance and controls and governance. Then we brought in a very senior professional as head of financial management and strategy. There are a couple of other senior hires, which we will look to make to plug certain gaps that we have. And then on the business side, wherever we think that we have a capability gap or a client segment that we'd want to get into, or a product set that we'd want to fast track, and we need to put some real talent behind that, we will make those hires. So I think it's a dynamic, ongoing process, and we will keep refreshing and strengthening our management pools.
All right. Thank you so much for joining in, Ravneet, giving us clarity on all the parameters. So resolution on stressed accounts expected this quarter. They're looking to raise growth capital, and about 25% of their real estate exposure has been captured in BB and below book. That's the take from Ravneet Gill speaking to ET Now. On the stock, it continues to languish in trade.